Let's start with facts. With surging silver consumption worldwide in the last 2 years. With demand surpassing supply by over 50 million ounces a year during the same time frame, current silver price is down almost 30% from its peak in 2020. How is it even possible? The answer is gold and silver fractional banking system, where price discovery has nothing to do with real supply and demand. A good illustration of entire US financial system, where markets completely divorced from underlying economy. Hello everyone. Today, we will talk about gold and silver fractional banking system. We will talk what it means, how it was created, and why, despite all of its sophistication, it is very fragile and vulnerable and will eventually collapse. We will also talk about a role of gold and silver as an insurance when it happens. Reason for this video was an article by Ronan Manley, from bullionstar.com, describing revelations by one of the London's prominent gold and silver insiders Peter Hambro. I will put a link in the description. It talks about use of paper gold and silver by main bullion banks to rig the price of precious metals. Who is Peter Hambro? He is a lifelong gold and silver executive, that comes from a long English banking dynasty, going over 100 years back to his grandfather Carl Hambro, a founder of famous English investment bank Hambros. From 1983 to 1990, he was a deputy managing director of legendary London bullion broker Makata and Holtzman, which was one of the 5 original bullion dealers that started London bullion market all the way back in 1850s. After that he was a founder of one of FTSE-listed gold mining companies. So he definitely knows what he is talking about and has a first-hand knowledge of all the nuts and bolts of secretive London bullion market, all the manipulations by LBMA and the other metal markets. According to Hambro's bombshell revelation. Since 2018, financial stability desks at the world's central banks have followed the Bank for International Settlements, BIS, instruction to hide the perception of inflation by rigging the gold market. But since the central banks need cover and cannot be seen to be rigging the gold price, Hambro continues, the only way to achieve the cover is by smashing the price of physical gold by the alchemical production of paper gold. Why 2018 and why I think it makes sense? 2018 was year of famous Powell's pivot, when in response to Fed tightening, financial markets started to crash. As easy money started to flood the system, prospects of inflation became very real. For the reasons I wouldn't want to discuss on YouTube, I am walking a very tightrope here to avoid naming some events that followed. But to put it mildly, in 2018 and in 2019, financial system was frying. And as all of us know, the only thing that keeps current fiat financial system functioning is the public trust. So having an uncontrolled spike in gold and silver prices would have put an undesirable spotlight on inflation. So how the scheme works. Here is Hambro's explanation of evolution of the paper gold market from 1980 all the way to today. With the help of the futures markets and the bullion traders, yes, that includes me, we managed to create an unshakable perception that ounces of gold credited to an account with a bank or bullion dealer were the same as the real thing. Once investors swallowed this stupefying pill, it was easy to sell them gold that simply didn't exist. We said, don't bother to pay for it, just give us an initial cash margin and agree to a variation margin and our paper promise is as good as gold. This was the simple derivative. If you thought the price would go down, you could sell us gold you didn't have and margin the trade in the same way. Then along came a raft of options and other products, and the derivative market, for that is what this chimera was called, started to spiral like a tornado. Hambro continues. The Bank of England was then, as of now, always ready to prop up the London paper gold Ponzi with some physical gold when needed in the form of central bank gold lending. To make the bogus gold look even safer, the Bank of England was quietly willing to lend the London gold market members physical gold, in the event that things got a bit tricky and our vaults were empty. When one of the members went bust, the others clubbed together, and with the Bank of England holding the ropes, the customers were bailed out. Here we have a complete mirror image of fiat fractional banking system. Gold and silver are sold via unallocated accounts supposedly held by bullion banks with use of US dollar to provide margin, with Bank of England acting like Federal Reserve, as a lender of last resort. In addition, this global paper gold scheme has limitless supply since, as Hambro puts it, governments and central banks and the BIS can print the margin. Which is why, Hambro says, the great banks of Wall Street will accept fiat dollars as margin and manufacture gold to swamp the market. Today, international derivative market dwarfs the amount of actual gold and silver available. Market makers on COMEX and other marketplaces act as an unlimited counterparty to a position of almost any size. You can buy or sell a huge amount of paper gold and silver with options and futures, while putting just a few percent to cover margin requirement. The whole derivative market is based on mathematical models, like Black-Scholes, and not on a real supply of precious metals. Precious metal markets, as we know them today, are basically a big casino, with market makers running statistical bets that set to win over the long run, while collecting various fees. This enormous paper gold and silver market absorbs the money that would have otherwise gone into physical bullion, diluting real quantity on metal out there and obscuring the real price of the physical assets. Some are wondering why the price of gold is not consistent with inflation and global risks. The answer is simple. It is. Real, physical gold and silver, left to free market, would have provided a complete hedge against money printing. You can't print gold. So I am buying as much of physical gold and silver as I can while paper gold and silver keep the real value artificially low. The whole derivative scheme works great, until something unexpected and massive breaks. Every retail trading platform has a standard deviation calculator that predicts a statistical probability based on historic data to help you to feel in control of the risk on your position. But no one tells you that once you cross into a very low probability territory, whole system implodes under the weight of massive losses that are not supposed to happen according to calculations. At that point, exchange-derived prices of asset become meaningless, multiplying exponentially, propelled by algorithmic trading. All the while underlying supply and demand for an asset never changes. Black Swan event. We still remember LME nickel debacle. It took a small market with outsized influence by Russia, and well-oiled mathematical model ran into a hard limitation of real world and collapse followed. Now, the incident was swept under the rag and localized by a complete reversal of all trades. There is a lawsuit, but as Hunt brother have learned, justice is only partially blind. Can what happened to nickel also happen to silver market, or gold? We will see. The whole precious metal market looks like an inverted pyramid balancing on its tip, while economic uncertainty is trying to tip it over. All it takes a run on a COMEX or LBMA and the whole system collapse. I am not a financial advisor, this is just my opinion only. Today's financial markets are very interconnected and Black Swan doesn't have to originate in precious market sphere. It can be a drop in dollar that trigger chain reaction, a default in Asia or Central America, or energy crisis in one of the European countries to trigger the domino effect. All we can do is try to prepare ourselves. Gold and silver can be one of the ways to do that. Thank you for watching. Please subscribe, like and share if you found this topic useful or interesting. Until next time.